Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The Festival of Lights is here, which is why the location of our date this week has shifted from the studio to the offices of India's third largest mutual fund house, Aditya Birla Sun Life Mutual Fund. Now, there's a lot to talk about. There's volatility in the market. Equities have been coming down. There's talk of defaults in the credit market. So, what should you be doing with your mutual fund portfolio? What are the kind of funds to back? What is that you should perhaps avoid? There's plenty to ask the men who manage money at this large fund house. So let's get started. Come on in. Hi, sir.
Hello.
Thank you so much for having us over. Good to see you, and season's greetings to you and everybody at Aditya Birla Sun Life Mutual Fund as well.
My pleasure, and on my behalf, as well as from Aditya Birla Sun Life Mutual Fund behalf, to all the viewers, a great festival season.
Thank you very much. You know, it's been really interesting, and I think that's what markets are all about, right? You have one good year, one not so good year. Right. Last year, the sentiment was very different, the mood was very different. However, this year I think has been a year filled with learning. But just your thoughts when you're looking back from last Diwali to this Diwali and everything that's happened in your industry.
Of course, it's been a good journey for the last maybe take 5 years or 10 years. Yeah. So it's been a great journey, and so I always keep saying that every 3 years of a good period has to followed by 1 or 2 years of bad period, and then the cycle just goes on like this. And even the last 2-3 months, we saw actually a good pickup in the consumer durables sales, and after the GST implementation got stabilized, we saw actually things were coming back to normal. The last 1.5 months have been pretty challenging.
Suddenly, September onwards. Yeah.
Exactly. I think we also seen some of the institutions which have showcased their presence for the last 23 years, more than 2 decades of their presence in India, and considered to be the one of the best institutions from the financial service market, and suddenly it collapsed, and due to various reasons. So that actually, of course, definitely changed the mood of the financial market. I always call it as a passing phase.
Okay.
And
it's a passing phase this time around as well?
It's a passing phase.
Okay.
I think if you look back the history, we have seen 2008 crisis. We've seen 2013 when the currency actually became extremely volatile. And we actually similar kind of event. Sometimes we say that is not the same as 2008, but no any one event repeats the next time. But any new event is different from the earlier event.
No, absolutely. I'm not even going back to 2008 because I was also tracking the financial markets back then, and that was a very, very different time. Those are hopefully just once in a lifetime or once in a generation kind of events that will happen.
Correct.
But just talking about some of the other things, apart from the volatility that we've seen, this has been a year of a lot of changes for investors, a lot of regulatory changes. I mean, the regulator came out and decided to exactly define what will go in a large cap fund and a mid cap fund. New categories like a value fund, a focus fund, clearly defined categories also came into being. And then obviously just towards as we are getting into Diwali season, the next change happened in terms of the way expense ratios will be dealt with, commissions, etc. So from a regulatory standpoint, how do you define the year for the end investor?
I think if you look at the customer in the center of the piece, and I look at actually the various regulatory framework that has come, I think to large extent the customers have been the biggest beneficiary of the change that has been brought in, as well as make them actually benefit out of the mutual fund investing in the long term.
Sure.
One good thing that has happened in the last few years, I think I always say that post demonetization, the industry has now become one of the key industry in the financial market. I think the role that mutual fund industry is playing has actually is increasing quite significantly. At the same time, from the investor's point of view, there is a significant confidence that has come on the back of investing in mutual funds. So that's, I think, my view, the fundamental change that has come for the Indian mutual fund industry.
That's actually true because we do the show Money, 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 and we run a personal finance segment as well, and we don't see too many people calling in with panic saying, should I sell, should I exit, and now my fund is down. People seem to understand that if the market is down 10% on the index, if individual indices are down 20%, then funds will suffer. But that actually also brings us to the asset allocation mix, because the one question that is out there right now is that should I be tweaking my portfolio to a certain extent? Should I be rebalancing? So for asset allocation, what would your advice be now?
Asset allocation is again a function of the goal that you have set for yourself, and how those goals are being met on the basis of the various investment that has been made into various instruments, which includes equity as well as debt. And this constant rebalancing of your portfolio is a must for every investor. The question doesn't arise. And that I think is done by generally by investors themselves if they are well informed. Otherwise, they need to be done by they need to be done by the distributors who are advising them. And that's something which I think constantly needs to be done. At the same time, having seen the way I think each of the asset class deliver its performance over long term, and equity as an asset class has to play a dominant proportion of the portfolio in order to get your long term wealth. And the fixed income also should be actually part of your portfolio to give you a protection in the overall portfolio.
But if you were to talk about your money, I mean, I know this is a tough question because long-term money doesn't shift so easily. But looking at the current environment, and if we're talking about moderate risk appetite, and it's a sort of growth-oriented portfolio with some requirement of protection as well, then what would be the debt equity mix for you right now?
I think the best way to start always is the 50-50.
50-50.
You start with 50 in equity and 50 in debt.
Okay.
And then depending upon where the interest lies, depending upon what the outlook that's emerged actually in each of the asset classes, taking into account the macroeconomic environment, as well as the goal of each of the individuals, that how the travel has to work, and then they keep taking that 50-50 actually to either 60-40 or 40-60.
Okay.
And my case is at this point of time, almost about 58% of my investments are in equity, and the balance actually is in fixed income.
Okay, well, fantastic. That gives us a starting point. So 50-50 is the way to go if you're, just absolutely neutral about it. But it'll be broken down with, lots of factors, your age profile, your risk profile, etc. What we'll do is we've just gotten started. This is just the warm-up round. We'll take a break on that note. On the other side, we talk about equities threadbare, and we also bring in the man who manages the entire equity AUM at Aditya Birla Sun Life Mutual Fund. We'll have Mahesh Patil join in the conversation after a very short break. So keep it with us. Welcome back here with this special edition of Money, 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 and this week we have trooped out of our offices to come and meet the men who manage money at Aditya Birla Sun Life Mutual Fund, the third largest fund house of the country. You've just been hearing some of the initial thoughts with Mr. Balasubramanian. It's now time to talk equity, so it's a good time to welcome in Mahesh Patil. Mahesh, please do join into this conversation. He's the man who manages assets under management of almost 90,000 crores. It's a lot of zeros. Let's not even bother with it. Season's greetings, first of all. Thank you so much for joining into this conversation. And that's what we were just talking about, that it's been a far more volatile year. From last Diwali to this Diwali, this is a year which has taught investors again that the equity market doesn't only go one way, right? So as you're looking at this current environment and you're looking at the fall that's set in, what is the message that you'd like to give out there to investors?
Yeah, let me first of all say Happy Diwali to all our viewers. Yeah, indeed, this year has been a pretty eventful year. I mean, after last year when it was a one-way ride, I think investors are really seeing the true color of equity markets, right? And we had some macro headwinds domestically, and also global environment is turning a bit negative. I would say that the correction what we have seen in the market year till date, it's been a wide correction. I mean, a lot of stocks in the mid and small cap are down to levels which are now looking pretty attractive, and they've fallen by almost 30-40% from their peak levels. The macro concerns are still there, but I think there are signs of slight positive signs in terms of oil prices have started to correct a bit. Inflation is still benign despite the high oil prices and the rupee depreciation. We've seen inflation benign, so that should put some cap on terms of interest rates. And growth is slowly and steadily coming back in the economy. So given that, I would say global headwinds could take the market down still further from here.
That was my question actually, and I want to get both of your thoughts on this, because at the index level, we're still flat to maybe 1% lower at the Nifty level. Of course, you start going to individual indices and then the cuts get deeper and deeper. But at the headline index level also, do you see low levels? The reason I'm asking this is that retail investors have also gotten smart. They're now wondering whether I should buy now, or if it's going to fall even more, then let me wait if I'm getting things at 5% lower. So I think that's influencing decision making at the moment. So your thoughts on this?
No, I would say, I mean, there's always a chance that market could undershoot on the downside. I mean, no one is able to catch the bottom. And we've seen in the bullish markets also, markets have corrected 20-25% from its peak. I mean, more recently it happened in 2016. So given that, I think there could still be another 5-6% downside from these levels. Okay. But I think for retail investors, it's important to understand that as the market started to look attractive in terms of valuations, I think one should not really wait for the last 7-8% downside. And that is the headline indices. But the broader market, as I mentioned, the correction is humongous, right? So already there is value. So everybody looking to invest in the market, as I said, there could still be another 6-7% downside. This is a good time to really build a good equity portfolio with a longer term perspective. Like Bala mentioned, equity is always for long-term wealth creation.
Sure. I think Bala's answer lies in that badge that I'm seeing. Sip now. So is that your approach and thought process to the current environment?
I think one other thing that's clearly emerging the last few years, you can never time the market, and volatility increasingly becoming the part and parcel of the market. The only way to participate, I think that's something which is increasingly as an industry, even as a Birla mutual fund have achieved, is actually encouraging more and more SIP as a way of investing.
And it's astounding because even during this period of volatility, even September, the SIP inflow number, that's been very resilient, right? Around 7,000 crores is the kind of money that SIPs are pulling in.
Yeah, it's close to about 7,800 crores of money that comes in SIP. And if you look back the same number, about exactly 5 years back, it was just about 1,800 crores. From 1,800 crores now it's going to about 7,800 crores. And it just keep becoming, this SIP as a way of investing. It is becoming actually part and parcel of every individual's thought process. I'm sure the industry can only keep growing. And that's why I think US markets have become bigger in terms of as an industry.
That's true. But okay, so that's the basics. But Mahesh, having said that, I mean, as an investor, we still need to make our choices. Again, as a house, from what I read, your comments, recent comments, that the preference is not so much towards any market capitalization right now, because one also sees a lot of NFOs by the way of small cap funds in the market. Is this a time to think mid cap, small caps, or is this the time to think safety and make sure that the large chunk of your portfolio is in large caps?
So while the larger allocation will continue to be in the large cap and multi-cap scheme, I think we think it's time to really build some allocation towards even small and mid-cap funds. Because this is a time where you are seeing now good value emerge over there. I mean, there could be near-term volatility in the small and mid-cap space. They could even undershoot on the downside. But if you are building a portfolio for the next 3 to 5 years, I think there is a space, even for a small and mid-cap to be part of the allocation at this point in time.
I know mid and small cap, it's going to be all bottom up and we can't discuss stocks or companies, but just themes, stuff where you're seeing value in the market now, things that are exciting you.
So I think one is the banking and financial services sector, which is a large portion of the market. There I think because of the current problem which is there on the NBFC side and the liquidity challenges, banks or even NBFCs which have a good strong liability franchise, right? I think they should do well in the medium to longer term. So really I think we've seen a decent correction also in the NBFC sector. Not exactly in 2013 itself we saw a big correction. I think we are similar in that scenario. So this could be a good time to really build some of the good quality liability franchise stocks in the NBFC and the banking space.
So you're saying NBFCs that have a solid liability franchise
and the strong pedigree.
What about housing finance companies? They were the darlings till about August, and then things have suddenly changed.
So there again, there are business models are undergoing a bit change. There is a pressure on margin and profitability. So at the right valuations, they would look good. But clearly, we prefer some of the other retail NBFCs rather than the mortgage finance companies at this point in time.
So Bala, your thoughts on this as well, because especially people who put money in the BFSI funds, they are worried a lot right now because they have made a lot of wealth, but then again, the talk being that whether fundamental business models are changing for NBFCs. There's a lot of talk right now whether growth is going to slow down. What advice would you give to people who right now still have money in BFSI funds? And what advice would you give to people who, if they're aggressive enough, should they take a thematic fund approach and invest in a BFSI fund?
I think the whole financial service sector have to be looked at in line with how they play on the economy. Is a sector which considered as a proxy to the Indian economy. If you are bullish on Indian economy, then you ought to be bullish on financial service sectors. So the question doesn't arise that we should be either negative or underweight. At the same time, the current fluctuation that we have seen in the market is actually related to the valuation adjustment. The re-rating and re-rating actually is again function of various macro variables that actually impacts these sectors, as well as the sentiment that impacts the sectors. And the largely, of course, is also a sector is driven by not the consumer spending pattern, is also driven by the way the real estate market functions. And we go through these cycles, but from an investor's point of view, then allocations into these thematic assets has to be some portion of their portfolio. So about 10 to 15% of the portfolio, if you allocate towards thematic sectors like banking and financial services or consumption-led theme, and these are a theme actually permanent theme for India. See, one, you should have the ability to fathom the negative news.
There will be more
there
negative
will be
news?
some negative news which will keep coming. I think the negative news doesn't stop actually. So you'll see some kind of negative news coming in. The tolerance to understand the risk, the tolerance actually to fathom this kind of negative news and still stay confident of the sectors in the long-term point of view,
Okay.
I think is a must.
Okay, all right. So if you're going to be in a BFSI fund or any thematic fund, make sure it's for the long haul, or make sure you have the stomach to deal with a little bit of the churn that might follow. Okay, so let's talk about other sectors, Mahesh, that you like. Bala mentioned consumption.
Yeah.
What are the thoughts there? Because correction is happening, but people are again raising questions whether consumption patterns will be as strong or not, whether car sales and these kind of things will continue to be as robust.
So consumption, again, we have discretionary consumption, okay, and the consumer staples over there. So rural consumption is still fairly good, and that's been driving the overall consumption. You've seen recent numbers coming in from a couple of companies, so that remains pretty strong. And being election year, I think you'll see a lot of spending on the rural side, which should drive broader consumption.
So you'd rather, in your funds, you'd rather, sort of
companies
have
which are more oriented towards rural consumption, I think,
Okay.
and that should be fairly steady.
Okay.
Again, over discretionary consumption also, I think over a longer term, we still like that theme because that's where penetration levels are low. You will see demand remaining strong for a country like India, where per capita incomes are going up. In the near term, there is some challenge because various reasons, like in the auto sector, the increase in insurance costs, and also on the NBFC space, because NBFCs have been a big lender.
They've been financing a lot of this boom.
Some kind of a contraction over there can lead to some slowdown in terms of discretionary sales in the near term.
Okay.
But I think you're buying stocks, okay, for a longer term, right? So near term weakness because of short term factors. I think it's an opportunity to buy good quality companies with strong brand franchise and with longer term growth visibility in that space. So that's a sector which we think looks good from a really long term perspective.
Now, what happened in the last couple of months actually was people who by default had some investment in an IT fund, maybe thoughtfully, maybe just, unintentionally, suddenly found themselves sitting on windfall gains. Mahesh, how are you looking at IT? Because again, with the market correction, even this part is coming under some pressure. Maybe it's profit booking, or there are people who are saying whether there's a peak, near-term peak that's in place. But how do you look at stocks from IT, pharma, these export-oriented and rupee-sensitive sectors?
So I think some of these funds, rightly mentioned, because export-oriented have done well because the pressure on the rupee. But I think what you look at is really the fundamentals, right? Whether those are making big change, because that will sustain the longer term returns for these funds. So in the IT sector, we have seen some kind of improvement in terms of the growth outlook. Okay, US being growing economy, growing very strong, but the growth increase is just about 200 basis points or so. So they're not going to be really long-term high growth stocks.
Okay.
We have seen a good amount of re-rating in this sector because of improvement in the growth outlook. Also to some extent flight to safety because the other sectors were not doing so well. So IT remains a steady kind of outlook. I mean, companies are generating good cash flow, so buybacks are helping the stocks to support the prices. And in the current context, it should be doing fairly well, but it won't be really a big long-term compounding story. We've seen the big re-rating happen over there, and pharma remains still more stock-specific because
one announcement can change the fate of a stock in a single day.
And we are seeing the macro is not really improved that much, right? US, while the negative news has stopped, in terms of the plants and approvals over there, but the pricing in the US environment, generic prices still continues to remain there, and it's abated from around 10-15% decline to around 4-5% decline. But it's not really, it's growing very rapidly. So one has to keep that in mind, when investing in some of these thematic funds like IT and pharma.
So let me end this chat by asking you this. If Mahesh Patil is thinking wealth creation next 3 years, then what's your pecking order in terms of themes? And please throw in some of the micro niche themes as well. I mean, tea, coffee, specialty chemical stocks, anything that comes to mind. 3 years in terms of wealth creation.
So I would say in terms of sectors, it should be banking and financial, as I mentioned earlier. This is a good time to buy good quality franchise, liability franchise, because that will do well over the next 3 years time frame. Continuing with the consumption, consumer discretionary, I think near term there is some pain, but these are stocks, which would continue to grow at a faster pace, higher than the GDP growth rate. And very niche sectors like chemicals, specialty chemicals, I think that's an area where, because of what's happening in China, there's a big opportunity emerging for India. And rupee depreciation, I think, should help to find some good multi-baggers in that space. And across market capitalization, I would say no bias. I think large cap, mid cap, small cap, you pick your choice. I think they will all make good returns over the 3 year time frame.
Okay, all right. That's a lot of food for thought, and I think some interesting anecdotes that people can keep in mind as you're looking at re-rigging your mutual fund portfolio. Mahesh, thanks very much. That was most helpful. We need to take a very quick break, but Bala, we're not letting you go because there's another piece of the puzzle as we discuss asset allocation. If there's equity, there has to be debt. And for a lot of retail investors who had just started looking beyond fixed deposits, what does all of this turbulence in the credit market mean for you? What kind of debt funds can you still look at? That is what we will ask Bala in just a moment. Welcome back. You're watching this special edition of Money, Money, Money. We are here celebrating the festive season at Aditya Birla Sun Life Mutual Fund. It's been a roller coaster ride for investors over the last few months, the last 2 months specifically. And we've spoken a lot about equity. Now it is time to talk about the debt market, debt mutual funds, because Bala, you know, as I was saying earlier, I think the retail investor class just started waking up to the fact that there is a smarter way to invest in fixed income than just a fixed deposit.
Correct.
And just when this was happening, now we're getting all of these headlines from the credit market about defaults, IL&FS and stress building up. So before we got into this patch, a lot of the advice that I heard IFAs giving was that, 3 years is the time you look at because tax advantage kicks in if you're a debt fund investor. So maybe it's a good idea to stick with the good quality accrual funds.
Correct.
But does that advice still hold now in this environment? What do you think?
I think fixed income, it always holds merit for investors to invest and have it part of the portfolio. Irrespective of whatever the noise levels of the market, say, impacting your sentiment, impacting your decision making power. The simple reason is the fixed income is broken into two parts. One is the accrual, which of course the coupon that comes actually of every investment that you make. Second is your credit risk. And third is around the way the interest rate fluctuates. Your bond is also keeps moving up and down.
Sure.
But if you take a 3-year period or 5-year period, and most of the component you're talking about, especially the accrual component, which is your interest income, which keeps actually increasing your NAV, that stays constant.
Right.
And your price fluctuation keeps moving on the basis of either the credit loss or due to the interest rate movement. It actually leads to an increase in price or a decrease in price.
Right.
So if you take actually a 3-year period or 5-year period, it gets averaged out. And second is, as it actually advocates, the diversification is very important actually in equity. The same actually concept prevails actually in fixed income portfolio as well.
Okay.
Though I mean actually as a money manager we may end up losing some of our investments, as you rightly mentioned about LFS. Maybe some of us will lose actually money in that space. But it's, again, you have to understand this fact that it's only some portion of your portfolio you are losing. The rest of the portion of your portfolio is, let us assume 2% of the portfolio goes bad.
So this is, this is very important to understand, because for equity funds most people understand that the basket would be at least 35-40 stocks.
Exactly.
But if I'm investing in a debt mutual fund, and let's say there is a security that is going bad, whether it's IL&FS or any other sort of institution, typically what are exposures in a normal debt fund?
See, these kind of exposures, especially if you take below the
below AAA.
Below AAA.
But IL&FS was AAA, of course.
AAA. I mean, that's of course, it's I call it an accident, is one of case. But on average, in exposures, in our case, in most of the funds less than say AA and AAA, would be anywhere between 10 to 15%. Okay. 10 to 15. Within the 10 to 15%, you definitely, assuming scenario, you have some say 2 to 3% of your portfolio goes bad.
Okay.
But in the overall portfolio of 100%, that 3 to 3% is only a small proportion of the overall portfolio. Therefore, investor's point of view, if somebody stays invested for a 3-year, 5-year period, he doesn't need to worry.
So let's go back to what you said, that for you would look at a 50-50 mix between debt and equity for yourself, or maybe a 60-40 depending on the environment. So within the Aditya Birla Sun Life universe, which are the debt funds that you would put your money in right now? Where you think there's visibility, and maybe it can be a portfolio of 2 or 3 different funds, which could be a mix of gilt funds or duration funds, also accrual. What kind of funds do you like?
I think if you have 100 rupees of investment, you need to keep roughly about 20-25% in the liquid fund. Okay. And that 78% should actually spread between short duration funds and credit funds. And there are 2 funds category I think you can make your investment. Okay. The rest is 70%. Okay. I mentioned about short duration, of course, it takes into account the short-term fluctuation in interest rates.
That's 1 to 3 years.
Yeah, 1 to 3 years.
Just to clarify, this is as per SEBI's new nomenclature, and now it's very, very clear. You can actually go back and check the categories of debt mutual funds that are out there. So if it is a short duration fund, then it's investing in securities which have maturity between 1 and 3 years. So you know what you're sort of getting in.
Exactly.
So that's something that you would recommend.
That's something which I'll definitely recommend.
Okay.
And credit fund, again, as long as your time period of investment is anywhere between 3 to 5 years, even the credit fund should also be considered, given the fact that portfolio yields are good. And I think times like today, I think portfolio yields go up. Okay. For any incremental return that will come, actually, it will come on the basis of the ATM.
So even if there is a casualty,
even if there is a casualty
in between,
on overall, on an average basis,
the fund will recover.
I think fund will recover.
Okay, so there you go. You have a takeaway. If you're looking at fixed income investments, then apart from your usual liquid fund, which is an alternative to your savings account, you can look at the short duration fund and a high quality accrual fund, a credit fund. That's what Bala is saying. Now I'm going to round up this conversation by coming back to equity, because a lot of our investors are interested. Again, if you were putting your own 50 rupees out of the 100 back into your equity funds, which funds do you like the most at the moment?
I think equity is something which anyway you know it very well. We are taking a risk for long-term wealth generation. I think the biggest return comes actually when you take a relatively high risk, which comes in the form of investing in multi-cap,
right,
as well as in the mid-cap and small cap.
Okay.
Though at this point of time, yes, we look at the mid-cap, we will feel a little sad because the price fall has been pretty high. But I think that's where I think your earnings growth actually is going to be substantially better than the larger economic growth, and that's I think the power of company will actually accrue to you as an investor is only in the long term.
Okay.
Therefore, that's where I'll put my money. I think between multi-cap and mid-cap and small cap is one where I'll put my money.
Okay, Bala, I think this has been a very, very helpful conversation. Thank you so much for having us over to your office. And I think these ideas will resonate with our viewers as well. There you go, you've heard it. It is time to keep the faith, think about long-term wealth creation and go out there, because this is when the market is volatile, when things are looking all downbeat, that is when you really get in and try and make long-term money. Thanks very much once again, Bala, to you and your entire team. Now we also have to take your leave on this special edition of Money, Money, Money. Go out there, have a fabulous festive season. Go out and explore and have fun with your families. We will, of course, keep getting you more wealth creation ideas in the weeks to come.